It's not just retail real estate that's taking a hit. Those trying to sell office space are also feeling the pain as working patterns have changed. Large companies are holding off signing those property deals, leading to record vacancy rates worldwide. They're now running at around 16%. That's compared with 10% before the COVID pandemic.
North America has the highest individual rate. More than 1/5 of its office space is empty.
Major cities like Shanghai, San Francisco, New York and London have been hardest hit, struggling with the worst vacancy rates in decades. Properties and city centres are losing their appeal, with big companies moving to the suburbs.
Take London's Canary Wharf, which is home to the capital's major financial institutions. 15% of the office space there was empty at the end of the second quarter, and the rate is still rising.
Well, let's try and make sense of all this with Mike Ingram, senior market strategist at ActivTrades, the UK-based brokerage firm. Mike, welcome. Good to see you. First, give us a quick overview. Just explain how a property and retail giant like Cigna becomes the largest casualty in Europe's property crash.
Well, I think it's down to a combination of events, some of which you mentioned in your presentation. I mean, certainly soaring interest rates have played their part. Cigna Group, we don't know the total indebtedness there, but they certainly borrowed a lot of money, the cost of servicing which went up. It's faced with a sluggish European economy that's put downward pressure on occupancy rates, rental income, and as you've also mentioned, there are structural issues such as working from home, which is set to depress the demand, certainly for office space, for the foreseeable future. And then, you've got lavish spending that you've also mentioned. I think there was a 40 million euro yacht in there somewhere in the bill. And, turning back to the expenses of the business, things like, property development, construction costs, labour costs have all soared in recent years. So that's also put pressure on their finances. And none of that is good news. And all of it, I suspect, would have contributed to Cigna's demise.
I think Cigna Group eventually amassed something like 29 billion US dollars with at least 13 billion euro in debt. Where was all the oversight? How did it get this far before someone was able to say, look, this is out of order, you need to stop and sort this out?
Yeah, well, I think, 2023 has been a year where a lot of risk models employed by banks and elsewhere have really been turned on their heads. I mean, of course, in the US earlier this year, we had a sort of a mini panic in the mid-sized bank, Silicon Valley Bank. And it just seems that their risk models are unfit for purpose. They really relied on a zero interest rate environment. They relied on the fact that rates would have to be sort of zero forever, that asset prices would continue marching ever upwards. And none of this has turned out to be true over the last 2 years. And it seems like these risk models generally have been massively behind the curve. And certainly in this particular instance, it also appears that perhaps the creditors haven't necessarily been as stringent in demanding disclosure from Cigna. As you said yourself, the company has refused in the past to hand over necessary information for creditors to actually make an informed lending decision. That didn't happen. They've been caught out.
Just look into your crystal ball then for us. Let's look at the tea leaves, and more generally, global real estate seems to be in a real hole here. If we're no longer working full-time in cities around the world and we no longer need to live in them either, I mean, what is the future for the world's office space?
Well, I think it's fairly clear that it's going to be, structurally impaired going forward. I mean, yes, a lot of employers are trying to tempt employees back into the office, but when you've got large employers such as HSBC saying, we're going to halve our global real estate footprint, then you have to know that something, is up. The business model will have to evolve. I think it's as simple as that. I mean, over the short term, it may well be repurposing some of this excess commercial real estate, some of this excess office space into residential units. And for instance, here in the UK, we have a big shortage of housing. Over the longer term, probably a pivot towards more things like logistics, maybe factories. There's a lot of reshoring occurring from deglobalization, which is helping to drive demand in other areas of commercial real estate. But also it might be there's a broader pivot towards residential investment at an institutional level. I mean, we've certainly seen private equity being quite interested in this space. And in any event, I don't think anybody should be, perhaps relying on selling office space in the future for a reasonably diversified commercial real estate portfolio.
Mike, good to talk to you. Thanks for coming on the programme. Mike Ingram, Senior Market Strategist at ActivTrades, the UK-based brokerage company in London.